The second form of business organization is a partnership. Maybe being a sole proprietorship isn't enough. Maybe you need a partner in order to carry out your business. A partnership is very much like a sole proprietorship, except, as it sounds, you've got two or more people operating that business. There are several kinds of partnerships. You can have a general partnership where all of the partners are general partners, all of the partners operate the business, and all of the partners have unlimited liability. Typical examples of a general partnership are law firms, accounting firms, consulting firms, firms where a group of people get together to perform a particular kind of business. You can also have limited partnerships. In a limited partnership, the limited partners simply supply money. They have nothing to do with the day-to-day running of that business. And they have limited liability. If the partnership goes bad, the worst that can happen is that they're going to lose the money that they invested in that partnership. A limited partnership, however, has to have at least one general partner who does have unlimited liability. Typically, limited partnerships are oil and gas exploration partnerships or real estate partnerships, where you have partners who provide the money and then the general partners go out and actually buy the buildings, manage the buildings, handle the exploration for oil. Now, like a proprietorship, a partnership has very similar advantages and disadvantages. With a partnership, once again, it's easy to form. You get two or more people together, and they say they want to be in partnership, and they're a partnership. Just like a sole proprietorship, there are no corporate taxes. All of the income is passed through to the partners, and they pay personal taxes based on the amount of income that they receive from that partnership. Now here I have a minus sign. This is, could be plus, could be minus. There are varying degrees of formality. With a sole proprietorship, you simply have to say, I'm in business, and that's it. You're done. You're in business. With a partnership, typically it's wise to have some kind of a partnership agreement, have a legal document that spells out this is how much capital each partner is putting in, this is how much of the profits each partner is getting out, and again, this is up to the partnership to decide how formal they want to be. If they're going to work on a handshake or if they're going to work on a long legal document that spells out what each partner is responsible for. Unlimited liability, again, the general partners, just like the sole proprietor, have unlimited liability. Their personal wealth is liable if there's a lawsuit or if there's a bankruptcy. Limited life. If one of the partners decides to leave, they get tired of the business, they want to retire, then you've got to renegotiate that partnership agreement. And typically the partnership agreements call for you to buy out that partner who is leaving and then renegotiate the partnership agreement. Hard to transfer ownership. Again, you can't sell your interest in a partnership to someone else. You need to totally redo the partnership agreement if you're leaving and somebody else is entering that partnership. And hard to raise capital. Well, yes, you should be able to get more capital than the proprietorship. Now you have two or more people who are giving capital into the partnership. And again, you can go to the bank to raise money. But still, you might not be able to get all of the money that you need to keep that business going. The third form of business organization that I'd like to talk about is the corporation. Now, I said earlier that there are more sole proprietorships than any other business form. And you might say, well, why aren't we spending more time on sole proprietorships and not on corporations? Well, while it is true in terms of the numbers, there are more sole proprietorships. In terms of the revenues and the profits that are generated, overwhelmingly, the bulk of the revenues and the bulk of the profits come from corporations. So in terms of importance to the economy, the corporate form is the most important form in terms of its impact on the overall economy. Now, with a corporation, there are a lot of advantages. First, unlimited life. The corporation can keep on going and going and going, and there are some corporations that have lasted for a really, really long time. When I talk about this in my classes, I have a picture of King Charles II of England granting a charter to the Hudson Bay Company in 1600-something. The Hudson Bay Company was a company that owned pretty much all of Canada and a pretty good chunk of what is now the United States, and they were a fur trapping and trading company. Well, believe it or not, the Hudson Bay Company is still in existence. It is now a Canadian department store chain. And I might add, the Canadian's very angry because it was just purchased by an American, but that's a side story. But here it is. It has been in business pretty close to 350 years. So when I say unlimited life, I really mean unlimited life. A corporation can last a very, very long time. Another advantage of a corporation, it's easy to transfer. You have shares in a corporation, and if you don't want to own that corporation anymore, you want to get out of the business, no problem. You can sell the shares that you have in that corporation. That doesn't impact the corporation. The corporation still goes on as usual. It just means that instead of one person being a shareholder, somebody else owns those shares, and that has nothing to do with the day-to-day running of that corporation. And a big one, limited liability. If you own shares in a corporation and that corporation goes bankrupt, the worst that can happen is that you will lose your investment in that corporation. Nobody can come after your personal assets, even if you're incredibly wealthy. Those assets are safe. Only your investment in the corporation can be lost. Specialization is another big advantage of the corporation. When the firm gets larger and larger, they can have people to specialize and perform various functions in the corporation. That's impossible for a sole proprietor to do. The sole proprietor has to do everything, do all of the functions in his proprietorship. A corporation is a legal entity. Legally, it's like a person. A corporation can sue. A corporation can be sued. A corporation can enter into contracts. It can own land. It can do literally everything that a person can do. It is an entity that is separate from its shareholders. It is a legal entity in and of itself. And a really big advantage, it's easier to raise capital. A corporation can go into the debt market and into the equity market, raise new equity by getting more shareholders, raise debt by going into the public and private bond markets and get more money. Typically, the difficulty in raising capital is one of the things that limits partnerships and sole proprietorships. In the corporate form, it is much easier to raise capital. Now, those are a lot of good advantages. There are, of course, some disadvantages associated with corporations. One, more regulations and more cost. And the bigger the corporation, the more regulations that corporation faces. It is costly. There are forms that you have to fill out. There is paperwork that you have to do. And again, for a corporation, that regulation can end up being very, very costly. The big one, double taxation. A corporation has to pay corporate taxes on the revenues that it earns. Then, any distributions that it makes to its shareholders, the shareholders have to pay personal income taxes on those distributions, so that money is double taxed. Now, while this almost always is cited as the main, overwhelming, big disadvantage of a corporation, in some respects, it's not as bad as it sounds. In terms of the double taxation, if a corporation is planning on passing through all of the money, in other words, it earns net income and it plans on paying all of that net income as dividends, well, then that's true. That double taxation can hurt. The shareholders first see the income taxed at the corporate level, and then all of that income is taxed again at the personal level.